All right, welcome back to the ETF Inspector. We've got another special video here, interview with Mr. Mike Khouw. So Mike, welcome back to the channel again.
Thank you very much for having me again.
Yeah.
Happy Thanksgiving, belatedly.
Yes, happy Thanksgiving. Now, are you a Black Friday shopper? Did you go start getting the Santa rally going, or no? I mean, obviously you're at work.
So yeah, it's interesting. And actually, I'm working from my home office, so that's fine. I may be working. We'll figure this out. I have to fly to Florida this weekend, so I might work from Title's West Palm Beach offices, which is actually technically, I think, my official office address is in Florida, interestingly enough. Wish I paid Florida taxes. That would be a lot nicer than California taxes. But so some of the gifts that I'm getting for this year, I actually got already, and I had bought them well before. So, for example, for my wife, she probably won't like the color, but I happen to pick up that. I also got my wife's birthday and Christmas it's really close together. So she's her birthday's in December, and then we've also got Christmas. So got her that, and I also got her a trip to Hawaii.
Oh,
Christmas.
Wow. All right.
So we're gonna go to Hawaii.
Very nice. So I ran out to the store just because we needed some things, but I was surprised. I mean, I was never a Black Friday shopper, but I remember when I was a kid, my aunts and uncles and parents would go, and it was just craziness. I went to Walmart to pick up some things, and I didn't even have to wait in a line to pay. So I think everybody shops online now, right?
Yeah, I certainly do. I'd much rather not go to a store. I'm not a browser. I don't like dealing with the Christmas shopping madness. I mean, it's a little bit of fun. There's something very satisfying about, going out and saying, okay, I got a little something for everybody, and now I've got a box. There's something a little bit more hands-on about that than just clicking buy this, and then just having the boxes show up, and there's something not very personal about that.
Right.
Whereas going and finding something, and hopefully they wrap it for you. Not so good with that.
Yeah.
But yeah. So some of the shopping I've already taken care of.
Nice.
Luckily.
Okay, so before we get started, I just want to, I'm not going to go into a big introduction because Mike's been on the channel before, but Mike Khouw is the chief strategist over at YieldMax, and today's video, the big picture, we wanted to talk about the Target 25s, new funds that came out, I think about a week, maybe 10 days ago. We'll just talk about them, learn a little bit about them, and then we'll move on to a couple other questions since I do cover a lot of YieldMax, and I just come up with questions, and so I get the chance to ask a question. It's kind of like a Spaces talk where I get all the attention instead of having to share it with everybody else. So we'll start off the Target 25s. You got I hate calling it strategy, but we still do. MSTR, strategy, NVIDIA, and Tesla. So my assumption was that those three were chosen because they're your most popular individual income funds. Based on assets under management. Was that the thinking that went into it, or is that just a coincidence?
Well, I don't know that there's a coincidence. I mean, those are probably the most popular single stock covered call ETFs, because those are also the most popular single stock options. So if you take a look at the most active single stock call options, it's basically those three. I mean, it's NVIDIA and Tesla are always 1 and 2. So those are the most active notionally on any given day, by a long shot. So whether it's people who are buying options or whether it's people who are doing overwriting strategies, that's just what trades the most. Also in that sort of big top list, and in fact, while we're doing this, I'm going to pull this up on another screen because I'll just see what the most active are today. But I can say for sure that, obviously strategy is extremely active as well. So for example, today, what do we got? And this is only a partial day. So we have, a partial day it's after the holidays, trading volumes will be lower, and it traded 600,000 contracts, which is 61 million shares worth of $180 stock. So that's, you're looking at close to 11 billion notionally
on a day most people aren't paying attention.
On a day when most people aren't paying attention. And it's also kind of interesting is that some of these stocks, the options volume is so large that it actually, in terms of the amount of shares that are represented by the options that trade, it's more than the number of shares that trade. So for example, MicroStrategy traded almost exactly 15 million shares today. But again, 61,000 options contracts is 61 million shares worth, because each contract represents 100 shares. So you're dealing with something that has traded four times as much stock options as it has stock. So these are the types of things where it's going to make sense to launch a product. And it's not because we are making a determination about whether people care about these things or not. The market has spoken. This is what people are trading. And if you want to have a democratized product that does some of the work for you, you might as well focus on the place where people are actually doing it. There's probably a lot of other interesting stocks where no options trade. So for us to launch a product on that, no one seems to be interested.
Right. Okay. So can we go a little deeper? Can you just give us an idea on the trading strategy for the Target 25? So I don't know if you've watched my channel, but I download the holdings, kind of sort things out, make it a nice picture for people to see, and then kind of explain it. So I see very similar to the individual incomes. You've got your synthetic combo, and you're basically selling call spreads. Now, is there, I know I'm asking like a really long question. I actually have a lot of long-winded questions, but so is there opportunities to do other things other than the call spreads within these, or are these very much call spreads? And then how are you selecting the strike prices? So like a two-part.
Yeah. So one of the things, and actually what I'm going to do is I'm going to when you see me looking away, it's going to be because I'm going to be comparing the conventional YieldMax. So how do you get the highest possible distribution, short dated, InVid, for example, to InVid, so that we're looking at the Target 25 versus the other one, so we can just see what some of the distinctions are. So to your point, first things first, we have the combos on. So the combos, for anybody who's looking, and the information I'm looking at would be the same that you guys will see as of the making of this video, because I'm pulling my data from the overnights, right? So same as you would be.
Yep.
So we've got the January 185 combo. So it's short the 185 spot 01 euro put flex, and then it is long the January 185 calls, right? So that's the combo portion. And then the options overwriting position is the DEES 25 186 and 200 calls, short those, and long the 202 and a half and 220s, right? So you basically have two short call spreads. And now there's a couple things you're going to notice if you're looking at these compared to some of what might be going on in the InVid strategy. The first thing you're going to observe is not just that it's call spreads, but take note of the expiration, right? So
December 19th.
Yeah, exactly. So the expiration is a little further out. Now, what does that do? It does two things. One is that one of the things we know about options is that they decay as a function of their own value fastest as expiration approaches, right? So that means that, like an option that expired today, it has to go to zero. The extrinsic has to go to zero.
Right.
So any extrinsic value, the one-day decay is 100% of whatever that is. So the decay rate of shorter dated options is higher. The flip side of that, though, is that the total amount of premium, extrinsic premium you're collecting is going to be lower, which makes sense. longer dated options, all else equal, have more extrinsic premium than nearer dated ones do.
Right.
And what that means is that because you're selling more premium, there's a little bit more of a buffer because of that premium that you're selling in the event that the underlying stock declines than there would be if it was really short dated. And an easy way to imagine this is, imagine that I sell a 1 week option for $1, or I sell a 9-month option for 10 on the same underlying stock. So the decay rate on that $10 option is going to be much, much slower, but its benefit if the stock declines as a buffer to that downside move is going to be substantially higher. It's 10 times as big.
Okay.
And what we refer to that as is, well, two things. It's going to reduce the delta of the strategy, and it's going to reduce the gamma, which is the second derivative. That's the rate at which delta changes. So what you're going to end up having is slightly lower rates of decay, and we like decay in this case because decay is a tailwind for a short option strategy, but it's going to actually smooth the results out a little bit.
Okay.
I actually gave, and I don't know if we did this when we did the earlier video, I might have shown you a chart. I had shown what a 1 year buy rate on MicroStrategy would have looked like if you had put it on at the end of December 2024, bought the stock at 300 and sold the 360 calls, which, by the way, were like 20% of the stock price. So 20% out of the money call was like 20% of the stock price. It was crazy. Well, if you had put that strategy on, now that strategies, I hate using strategy and strategy drives me crazy, but if you had put that strategy on, the volatility of that whole structure would have been much less than the stock itself, and it would have been much less than nearer dated call rolling activities would have been. And actually what's also interesting is that by now, at the end of the year, these calls are the 360s are going to expire worthless, right, most likely. I mean, strategy could bounce back. It certainly has done this. It did it last year. It had a big run. I also think it was horribly oversold. My own 2 cents about that. Not investment advice, but my own opinion. And so you'll see that effect. You can model that out yourself, but effectively, when you push the expiration out, it's going to smooth the results. It's going to reduce that positive theta. And that's what the target 25s are intended to do, which is get a little bit more of participation with the stock. And the trade-off is that you're going to reduce the distribution amount.
Okay.
Unless you're looking at target 12s, I guess it's higher in that case, but you get my point.
Sure. So generally, like if you're somebody that likes to sell, basically 2 weeklies in a row would bring in more income than a
yes.
a 2 week option, but the fluctuations,
but you have more volatility.
You're going to you could lose a trade that ended up at 2 weeks being a winner. In that event,
actually these are the 19th, so there's 3 weeks.
3 weeks, sure. And so
it's really a 3 week trade. So we can actually look at some of the math on this. So Nvidia, if you look at the 190, we'll go down like this. We'll look at, say, the 185 calls. The 185 calls in Nvidia closed at just over $1. So those are the ones that expire next week. Okay, that's on December 5th. Now I can go out to December 19th, and let's see. And those are, well, actually the vol is pretty attractive. So those ones are they actually are going for 3. That's not always the case, and I think I know why. Let's double check, see what's on the events calendar. So one other quick point is that if there are any events that can make something volatile, you're going to see that if you look at the term structure of implied volatility, it might be low, then spike, and then drift lower.
Sure, we see that with earnings, right?
Well, it could be something like earnings, or it could be a shareholder meeting. It could be
big announcement
something like that. So I happen to be looking at it right now. I'm going to just take off last week's. So there actually is there's a big bump in implied volatility for the week of the 19th. So actually, in this particular instance, I think you're just flat out better off selling those 19s because those are about 375-ish.
Okay.
So they are more than 3 times for 3 weeks. And that's because the implied volatility for December 19th is 41 and the implied volatility for the options expiring next week is 38. And if you're looking at the term structure, it's interesting because you're going to see it go up and then it's going to come down and then it's going to go sharply up again. Why does it go down? Well, one other thing that often will happen is on periods that are expected to be quiet otherwise, like Christmas week. What happens Christmas week? We got Christmas Eve, which is a half trading day, and Christmas Day, which is not a trading day.
Right.
So the options are not going to have 5 days worth of vol built in because there's only 3.5 trading days. So now just a quick point, this may or may not interest your viewers. Mm-hmm. Just because the market isn't open doesn't mean that there's no vol. One way to think about that is there any value to an option that would let you trade the change in price between the close of business on a Friday to, let's say, 10:30 a.m. Eastern time on Monday? And the answer is, of course, there is some value because over the weekend, the Asian markets could have some kind of catastrophe. There could always be something that comes in from the side. So a non-trading day is worth much less than a trading day, but it's not worth zero.
Sure, that makes sense. Yep.
Yeah.
So now, as far as we've talked about, I think it was Jay that kind of told us that there wasn't a lot of technical analysis that went into selecting of strike prices. Maybe this was specific to like an ULTY conversation. It was basically if ULTY was supposed to be paying 85% back at the time of the conversation because that was the implied volatility, then they were going to sell their calls at a strike price that generates the income to be able to pay an 85%. So is that kind of the same mentality being used for the 25% target 25s? Are we selling at a strike that brings in that income, or is there more technical analysis? We can probably generate more income and we're just keeping the rest in the fund. What's the thought process on the strike price selection?
So on the strike price selection, in the case that we just, in the NVIDIA example, you'll notice that there's 2 short call spreads. The objective is that we would like, if at all possible, to capture some incremental capital appreciation in the underlying stock, for lengthier periods of time. Now, I just want to throw one quick caveat into all of this, which is that folks will remember that in order to remain a pass-through entity, you have to distribute at least 90% of, within a tax window, 90% or more of whatever income you generate. And that's going to be in the form of realized capital gains, interest, dividends, if any. These stocks don't pay dividends that we're talking about right now, but if they did, and then the options premium that you collect. Now, so I offer that as a caveat because when you have a single stock covered call ETF and you use a combo, you can get into a situation if the underlying moves a lot where you must realize gains and then you're going to have to pass some of that back, right? Okay. Otherwise you're going to have a tax consequence, right?
Gotcha.
Now I just want to remind people though, this is one of those things, you want to minimize taxes. We're trying to maximize the total returns net of taxes. But bear in mind that if you're getting a big tax bill, that's probably because it did pretty well. So This is a better problem to have than, a realized loss that you can use as an offset someplace else. So we want to keep the tax burden as low as is practical and as the law allows. But if NVIDIA were to, say, double all of a sudden, we are going to have to realize some gains on the combo because the long calls are going to have appreciated so much that they're going to end up taking, they're going to be above the allocation rules. So you're going to have excess concentration risk in those calls. So you're required to pare that back, which means we would actually have to realize some gains. And then we have to distribute some of those gains. But the general idea with these is that we are trying to get a better participation on the capital appreciation side, undistributed, while targeting a distribution rate of give or take 2% a month, right? So that's the sort of the high level target. And the target 12s, I think, give people a sense of what the objective is and also illustrate how there can be a combination of nice distributions and capital appreciation. I think we saw that in, for example, Soxy. Big E, I don't know where Big E is right now, but I think Big E was up like 5% on a price basis, now 6. So the share price has increased by 6, but the total returns are 18.5%, and it's been distributing 1% a month. But if you get much better capital appreciation in something like Soxy, for example, you can actually get very nice appreciation, assuming the underlying asset does well, as well as good distribution. So that one's 18 and 32.5 reinvested, or 18 and 30, just in terms of cash distribution. So something like Soxy's performance that works out really well in something like a Target 25, because there have been 11 distributions. So that, that would have been, we'll call it 22% distributions, total returns of 32, and then you would have had capital appreciation of, give or take 10.
Sure.
So that's kind of handy, right? So if you're thinking about like, if you assemble a basket of these types of strategies, that's kind of what the ideal world looks like. The underlying stocks appreciate, you get decent capital appreciation, and then you also get nice distributions. Are the headline numbers quite as impressive? Well, not as impressive, but the returns are still quite good.
Sure. Now that's funny. Listening to you answer that, like, plays into a couple different questions that I have further down the line. So that kind of almost like it was.
Well, we can come back to those or delve into them more if you like, however you want to do it.
Sure. So I guess, I'll go to the concentration rules question I had first. So I've heard you speak about that before, so you said it again. And just in case people weren't fully getting what you were saying, right, in these individual income funds, you can't be too concentrated. It's based on the rules that you have to play by. So I already knew about if a call became too valuable. But the question then came up in my mind: what about if a put is not valuable but too large of a debit? Does that work in reverse? Do you have to close out a put?
Well, the interesting thing is that first of all, two things about that. If you put on a combo and the short puts value as a percentage of the overall fund has become very high, that means that the underlying stock has probably done very poorly, right?
Right.
Because the concentration rules stipulate that you can't have more than 25%. So we think about the concentration rules as like 5, 25, and 50 are the ways that I tend to think about it. So what's the 5% concentration rule? That's not necessarily applicable to the single stock covered call ETFs because they're not considered diversified. But registered, when you look at ETFs in general, it's good to have these concentration rules in your mind because it helps explain a lot when you look at the construction of some of these portfolios. And not ours, it's like any ETF. So what's the 5% concentration rule? One of the rules is that you can't have more than 5% of a registered investment company's assets in a related investment, which is a financial. So you won't see, for example, a lot of 6% allocations to JP Morgan, Morgan Stanley, or something like that, except in XLF, for example, which is the financial sector ETF, or even Berkshire Hathaway. So Berkshire Hathaway is often thought of as a financial. So that falls into RIC rules in terms of concentration over 5%. But 5% matters for another reason, and that is that if you have, say, a diversified ETF, you can't have more than 50% of the fund's total assets in individual constituents, each of which has more than 5%. So, put differently, you could have 8 constituents of a fund that have 6% allocations each, makes 48%. So those are all over 5, but if you put all the over 5s together, you're still less than 50.
Okay.
What's the 25? So the 25 rule basically is saying, okay, you're not going to have any one stock or one security. I shouldn't say stock. Let's just say security, because some funds aren't necessarily trading stocks. They could be trading options. They could be trading bonds, whatever. But other than a risk-free, what they consider a risk-free asset or a cash equivalent, so you can have it in treasuries.
Sure.
But outside of that, you can't have more than 25% in a single security, right? So even though you can have above 5% in just under 50%, that can't all be one. Like you can't have one 48%.
Right.
Right. So this is the rule that becomes applicable in this context, because if the underlying asset really starts to move sharply in one direction or another, the combo, let's take a look at this. So I'll look at the target 25, and we'll just take a look at the value in percentage terms. So the combos, remember what I said, the combos were the 185s, the January 185s, and the underlying stock is basically right there. So I can now go to NVIDIA's January 185 options, and we can see that they are probably going to be a relatively small percentage of, and actually the easy way to do this is to look at the value of an option that's in the combo relative to the stock price. Now, why do I say this is like a good rule of thumb or back of the napkin way to do these calculations? Is that in a covered call ETF, an unlevered covered call ETF, generally you're going to see whatever the total assets of the fund are is going to be functionally about how much of the underlying asset you're going to own synthetically. So if I had, let's say $10 million in a fund, I can divide 10 million by the $177 share price that NVIDIA is at right now, and say, okay, that's going to work out to functionally, 56,500 shares of the stock. Divide that by 100, it's 565 contracts.
Sure.
Right? But the easy thing to do is that when I look at January, I can say, okay, well, I know I have the 185 combo for January on. And I go to the 185 strike and I say, okay, well, the puts are $14-ish, 14 and a quarter, and the calls are $7.40. So if I take 14 and a quarter-ish, the current price, give or take, divided by 177, that means that position is about 8% of the market value of the fund. Okay. You sort of follow how I got there?
Yes.
Because I know that the fund's going to be basically unlevered, so one share. So I can figure out just I wouldn't need to look at the fund's assets at any point in time. If I knew what the combo was and I knew what the share price was, I can figure out approximately how much any one option's notional value is relative to the assets of the fund. So what would happen if NVIDIA, let's hope this doesn't happen, but if it went to 100, right? Mm-hmm. So it's going to lose 40% of its value effectively. If it lost 40% of its value, that 185 put has to be worth at least the intrinsic value, which is the difference between the strike, 185, and the stock price in that hypothetical, which is 100.
Right.
That's $85. Now, that's going to be $85 over the new share price, which is 100. That's 85% of fund assets. Mm-hmm. That is too much. So you're going to have to close it.
So even though it's a negative value,
it's a market value assessment question. Sure. The thing is that in that situation, you're not averse to making that adjustment. It's wholly collateralized. So this has nothing to do with the risk, because there was for every share, there was $180 worth of treasuries anyway.
Right.
Right. So you have the value of the shares declining, but it's wholly collateralized. There's no leverage. The thing is, when you roll that combo, you've now realized a loss.
Right.
And the realized loss actually means that from a tax perspective, you're good. From a money perspective, you're not good, because
right.
we bought the stock and it went down.
Sure.
But from a tax perspective, there's no reason why you, other than slippage or transaction costs or just, logistical inconvenience, that you would be uncomfortable rolling the combo down, because from that perspective, you're going to almost always be realizing a loss to do that. So all else equal, that's going to be helpful from a tax perspective. We are not averse to it. It's when it goes up that you're thinking, like, wouldn't it be nice if
Right.
it goes up, but not so much that we have to take gains for reasons of concentration,
Okay.
and therefore be forced to, at an inconvenient time, realize, because stocks will fluctuate. So if you go up and it doesn't trigger an event that makes you realize a gain that causes a tax problem within a certain period, these are selling covered calls or call spreads. If you just own stock, you want one thing. You want it to go to the moon.
Sure.
And we also would like that. But it does make things a little bit more complicated, because sometimes you have to take profits. And when you take profits, then you have to pay taxes. And
Gotcha.
so on.
Okay, so it works equally, positive or
Yeah,
negative. The concentration rules
look at
will force that transaction. Okay.
correct. Yeah. Mhm.
Man, let's see. You were talking. It was a concentrations question, and then something else. Maybe it'll come back to me. So I had one more written down question about the target 25s, and you probably can't even answer, but I know that. So I don't think you are allowed to tell us what the next target 25 releases are if they're not public information. But can you tell us when the next announcement is coming? Or if you can tell us.
I actually don't know, because that it's interesting. These things are not. They're not decided by us. It's interesting. We had a meeting earlier this week, and the question was going out between the people who actually issue press releases and the people who conduct the filings. So you have the legal folks that are doing the filings, and then you have the people who do the press releases and stuff. And the question came up, Mike, what are your thoughts? How soon would you like this announced? And I was like, is 4:15 this afternoon too soon? They're like, ha, 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 very funny. I mean, people aren't even going to be back because the traders, everybody who's involved with the investment process, we work every every Friday after Thanksgiving, even though it's a half day. But people who do other stuff, like legal or operations stuff that's not related to trading, this is commonly a holiday for them.
Sure.
Right? So they're like, no, we're not. That's not happening. It's not the way that works. I kind of think about it like that Staples easy button. As soon as in my mind something has been made up, I just want to hit the button, like make it happen right here, right now.
Sure.
Unfortunately, this is not the way things work. So, Jay and Mike and the other partners will make a determination about what they want to do. And then that sets the operational and compliance wheels in motion. And sometimes we're hoping it's going to come out sooner, and sometimes it doesn't. So I'm not 100% sure on that. I just know that there is an interest in getting more of these out there. I personally want to see enough of these that you can then create a fund of funds, because I think that's going to meet a lot of. I think there's a lot of demand for it.
I do too. I agree. That's what I hear a lot of, and that's me personally. I prefer. That was my follow up was, can we expect portfolio or basket fund target 25s, or are we sticking with individuals?
Yeah, I know that I want to see it. I know that Jay wants to see it as well. In fact, I mentioned this a few days ago. I have this idea in mind where I want all of my pay to drop into a target 25 fund of funds and only live off the distributions of that.
Okay.
That's like how I kind of want my own household expenses to work. I'm probably not alone with like my idea about DCAing into a target 25 fund of funds.
Sure. And
using it in this way. And my logic is that, every single time you get more pay, if stock prices have come in, it does two things. It sort of says, okay, meter your budgeting commensurate with how your assets are. Because a lot of times there is that wealth effect that, you see your accounts go up and people are just like, yeah, maybe I will buy a new car this month. You know what I mean? Whereas when you're getting regular distributions and you see how those distributions ebb and flow as a function of the value of the underlying assets, it's probably it's ironic. I think it actually is going to steady how people think about living as the beneficiary of an asset pool, the way like a trust manager has to contend with it. So yeah, I have like this kind of idea in my head that that's what I would do with that product once it comes out. So I'd like to see it.
Okay. Nice. I like to hear that. Yeah, I'm a Chippy and GPTY fan. I like Biggie. I haven't started investing in it yet, just because I've built a.
Well, because the ones you went into happened to not they knocked it out of the park. So I realized that then looking at Biggie probably seems less interesting.
No, I mean,
You know what I mean?
I like it. It's just more the money burned a hole in my pocket, and so I bought everything that I wanted, and so Biggie's sitting on the sideline as my buy this the next time you have a decent amount of money to jump in. But no, I'm buying Biggie for sure, and I just continue to buy into Chippy and GPTY. So, but I remembered the question. I thought I forgot it, but I remembered it. So when we were talking, I don't think it's going to be the case. Is tax loss harvesting a strategy that's able to be built into the target 25s, or since you can't take possession of the underlying, you're not going to be able to?
Oh, there is some tax loss harvesting that can be done.
Okay,
because you can opportunistically adjust the combo if there's something, if there's a loss, right?
Okay.
So because if I buy a combo and the end of the tax period is coming up, and so I know I can sort of lock in a loss in this tax period.
Okay.
So there is tax loss harvesting that can be done. It's not a big, in some funds, tax loss harvesting optimization is a really big deal because they have so many constituents, and they have also desired exposure. So you also have to make sure that you don't run into any kind of wash sale issues and stuff like this. So there may be circumstances where they want to take it. I think most of them are trying to manage it in such a way that there's like not a net tax effect, so that they can, if they want to harvest some gains, they can get some offsets. Because core holdings, one of the things you don't want to do is just trade into and out of stuff only for tax reasons. In the case of a covered call ETF, it's a much more straightforward situation, because the short options, they are what they are. They expire. You're constantly trading. Those are going to generate realized capital gains and losses. There's no way around that. What you do with the combos, there's a bit of flexibility about how you handle that.
Okay. Yeah,
but there's not a lot of flexibility, because you only have, it's a single stock covered call ETF. I mean,
Sure.
It is what it is. The stock's going to, do what it is, and you still have to contend with the other things we talked about, the concentration rules and things like that.
Yeah, I was thinking about in terms of, like, let's say like a YMAG decides they're going to take a loss intentionally, tax loss harvesting on say Apple, so they'll sell Apple, but then they'll buy shares of Apple and they'll trade a cover call strategy on Apple. So it's basically just like having Apple in the fund. So you're not going to be able to do something like that within these funds, right? You're not going to be able to buy the underlying.
Yeah, see, we can't buy the that's the tricky bit with these, and you can't buy the underlying stock, or you can't buy the underlying stock in any meaningful way,
sure,
because of the concentration rule. So could you? And here's the thing. So somebody asked me this question. They said, "Oh, I saw an odd lot of stock cross in one of the funds. I think it was ULTY." And I said, one of the things that does happen is that your short options and your short listed options, those are American style options. The people who hold those options can exercise them. Mm-hmm. And sometimes they do, even when they shouldn't. We saw a circumstance. I'm not kidding. We got assigned on some 187.5 calls in NVIDIA, or 187 calls in NVIDIA. The stock was trading 182. Somebody had seen the stock gun. I think maybe they saw that overnight or something after they reported earnings. Remember, the stock got up to like 192.
Yeah.
And they were just like, "Oh, exercise my calls." And so we walked in. We're like, well, you shouldn't have done that. We're glad you did.
Yeah, why can't I have that happen to me?
Right. Well, here's the thing: is that Scott Snyder, who's this senior trader on the meeting, he's like, of course this wouldn't happen on 1,000 lot, right? There's like 3 contracts,
right.
Which in that fund it's like, yeah, it doesn't really help us.
Sure.
1,000 contracts, that would have been nice. It would have been a quick $500,000 for nothing.
Would
have liked it.
Is there anything else you wanted to? I'm ready to switch over to like a couple ulti questions, but is there anything you're wanting to let people know about the Target 25s that you haven't been able to get out yet or haven't been able to talk about?
No, I mean, I think as long as people sort of understand what the objective is here, which is to get more participation with the underlying equity, slightly more modest distributions, and hopefully we're going to, again, it depends on the behavior of the underlying stocks, right? If these things all fall out of bed, that's going to be something else. Like I said, I thought Strategy was grossly oversold. And actually, let's just talk about that for a little bit, if we may. And again, not selling Strategy stock. This is not about MSTY or Target 25s on Strategy, but just an observation that I think is important for people to think about. And that is that Strategy in round numbers got 650,000 Bitcoin on their sheets. On Wednesday, and let's see where Strategy is now, because we got a little bit a bid since, but let's see, we are right now 177 in Strategy. That translates to a market capitalization of 50.9 billion, right? So just bear with me for a second while we just do a little bit of simple arithmetic together.
And I know where you're going with this, and I think Mara is in the same boat as what you're talking about with MSTY.
So now, so Bitcoin's now trading 91 billion, round numbers, at 91 billion. 91,000 times 650,000 Bitcoin is 59 billion.
So it's discount.
So 50, that's 59. So, all right, so let's talk about the discount, because I see people compare the market capitalization to the Bitcoin value. That's not the way to think about it. You have to look at it on a fully diluted basis, because Strategy has 10-ish, well, they've got about $15 billion worth of debt and preferreds. And, there's a lot of converts in there. But the important thing for investors in the shares to think about is that not all of those converts are struck anywhere close to where Strategy is currently trading. The strike prices in some of those converts is way, way higher. So what does that mean to the shareholder in Strategy now? That means that you get all of the incremental participation. You are not selling off the upside in Bitcoin's move until the stock is much higher. By my work, there's about 3.2 billion of convertible securities on their balance sheet, in their cap structure, which are in play today. So if I add the 3.2 to the 50.9, that gets me to 54.1, and the value of the Bitcoin on their sheets is 59, which means I'm essentially getting Bitcoin at a 10% discount.
And
Can Bitcoin go down a little lower? It could. I feel like so many people are shooting against Michael Saylor. I don't know what generates the hate. People get in a twist about this or that. His cost basis is just under 75,000. So I felt like people were shooting against it. Plus, it was the lower fib, and it's also the level from which Bitcoin broke out a while back. So I thought a lot of people were going to shoot against that number. Maybe they will. But to me, it has more to do with your long-term view on Bitcoin. Is your long-term view on Bitcoin bullish? And if it is, what's a better way to play it? Bitcoin itself, or Strategy getting to own
Bitcoin at 10% off?
10% sale. It's Black Friday, right?
Right.
It's a cheaper way to buy it. It's just my 2 cents.
Right, and it wasn't cheaper a couple of months ago. Right?
No. Well, that's the other thing. I mean, that's a kicker you could get. I don't know that it's ever going to trade back to the premiums that it enjoyed previously, but it shouldn't trade at a huge discount, right? So that to me is just a kicker. Like, is there a chance that it goes back to a premium? There is. Do I expect it to go to 2? No. But if it went to a 25% premium, that essentially means you have a 35% tailwind to your Bitcoin purchase, right? Potential. Gonna happen? I don't know, but I'm just saying it's in the realm of possibility. And so I just like it better as a long play there.
Yeah, it makes sense. And yeah, I don't want to keep on it, but it's kind of the same thing I make to my viewers why these ETFs basically trade at right about at their NAV. Some trade at a couple cents premium because it's basically a collection of money divided by an amount of shares. So if that gets off, if I'm not willing to buy in because I'm scared, the big money will absolutely buy $4 for $3.90.
Oh, of course, and that's exactly what they do. Is that they take a look at it and they keep it in line for exactly that reason.
Sure.
It's funny. Closed-end funds can trade at material premiums and discounts, and that those can persist. But something like this, where you can create or redeem, that can't happen for long because there are sophisticated market participants who are saying, "I know exactly what that bucket of securities is worth,
Yep.
and if it gets too far below that, I will buy it."
Absolutely. All right, cool. I got just a couple questions on ULTY because that's more of my I don't want to say area of expertise because that's giving myself too big of a head, but what I focus on a lot. So one of my favorite things about ULTY is the protective puts. But then I heard you talking about it was on when you were helping people understand return of capital and the distribution rules, and it kind of got me thinking a little bit more about them, and that I want to say they don't necessarily, I use quotes, like protect the NAV the way I thought. And the reason being is those protective puts, when they go in the money, once they're in the money, now they're offsetting the drop in the underlying one for one as far as values are concerned. But when you cash them out with distribution rules, you've got to pay them out to us over the course of the year, 90%. So it's kind of frustrating that that money can't basically turn into buying more shares at a discounted price, and that be the way of protecting the NAV. Instantaneously, it protects the NAV because it increases as the underlying decreases. Your assets under management stays the same, but you've got to pay that money out. So then that kind of leaves.
Yeah, we have to pay the money out if we do not have offsetting realized losses.
Right, but
which we should have that, because don't forget that if let's say I guess it depends. One of the things about ULTY is that ULTY owns the underlying shares. It's not trading combos.
Right.
If it was trading combos, there actually would be more of an immediate offset because you'd probably do some jellies. So jelly roll, by the way, is when you buy one combo and sell another, same expiration. So different strikes, but same expiration. So that's a jelly roll.
Okay.
Or you could take it and roll, up and out or down and out, depending on which way the underlying asset went. When you hold the stock, there are things you could do. You could we can roll into deep calls, for example.
You guys did that with Robinhood recently.
Yeah. So there are things you can do so that you can realize any monetization that happens on the long put side. Like I say, I'm really hoping that the ideal world for ULTY is that none of those puts ever end up deep in the money.
Right, but because you like to have them.
Yeah, we like to have them because it essentially means that we've got that tail risk on. And if you're trading high volatility stocks, tail risk does matter because, if you have a beta of 2 and the market goes into a correction, which is formally a 10% decline, or worse still, a bear market, formally a decline of 20%, and you're long all 2 beta stocks, that's going to be a really, really rough ride.
Yeah.
So tail hedges help out in that case. And depending on how far out in time they are, also, there are circumstances where you might even be able to monetize it, even if it doesn't blow through the strike. In other words, if I'm short a call or call spread, and I'm long puts, and I get a really short move down, like we had a Liberation Day kind of decline, even if it doesn't run through those strikes, you can monetize both legs. I can roll down my call spreads, I can roll down my puts, and basically cover the call spread I sold at a higher price, at a lower one and sell the puts that I bought at a lower price at a higher one.
Right.
Still bad because my underlying stock is not doing great, but I can make adjustments on both wings of that trade, which I think is good, and they do that.
Yeah, we see that all the time with ULTY when things drop. So
yeah.
Okay. I had another question as part of that, but I'll probably come back to it. No, I guess. All right. So speaking of the puts, whereas it's different from some of the other ones with synthetics, for the most part, ULTY's really not doing synthetics other than, like you said, when they kind of roll into a deep in the money call. Is there any consideration of ever taking assignment on the sold? Sometimes a lot of times you're buying the protected puts always in the collar strategy, but then sometimes you're also selling puts to generate more income.
We did that in NVIDIA. So we were not net short puts because we had sold 4,000, bought 8 against long 400,000 shares. So people who are watching, we're not in NVIDIA anymore. For people who are interested, by the way, I wrote an article that I originally entitled, why we don't own NVIDIA, or why we sold NVIDIA.
Specifically, ULTY?
Well, I mean, ULTY did happen to sell it, but why I was a seller, and basically, the logic on it was that, if you have exposure to equities generally, the top 10% of the S&P 500 are over 41% of the index right now. That is a really, really big percentage. And then you combine that fact with it's not like this is a super diversified group of stocks either. Once upon a time, you would have Exxon in there, maybe you had Polaroid Land in there. Lilly has been a huge company for, ages. So if you go back to 1970, Eli Lilly, which is one of the top 10, is the 10th largest company in the S&P 500. It was actually one of the biggest companies then. A lot of the other companies no longer exist. Like the company that owned Kmart back in the day. I mean, Kmart's out of business. Polaroid did go bankrupt.
We're showing our age.
Well, all these things.
There's young people that might not know what Kmart is. Do they mean Walmart?
Well, they don't. They probably don't know what Polaroid is. They're like, so they had these cameras, and you'd click a button, and you could pull the picture out already printed.
They're back. My kids like them.
They're cool. They're very cool, but this is how it was done. This was like the instant camera thing. Now everybody carries their phone around. That's like not an important deal. It's hard to believe Kodak and Polaroid were both companies filed for bankruptcy. My point is that AI is the hot thing right now.
Sure.
And if you look at the S&P 500, how many of the top 10 constituents, which represent 40% of the index overall, are tied to that trade? Well, I think we can say that Broadcom is, Meta is, Alphabet is, Microsoft is, and NVIDIA sure as hell is, right? So I look at that and I'm saying, okay, that's a lot of eggs in one basket.
Sure.
So, and I do believe that NVIDIA is going to be the most profitable publicly traded company in the United States next year, probably by a lot. $185, $186 billion in adjusted net income is probably my guess for that business. And that, by the way, justifies, given their rate of growth, that justifies a huge valuation. If you say, okay, I've got a company that's growing at well over 30% year on year, I would happily pay a 30 PE for that. And if they're $186 billion net income, that justifies a value, theoretically, of $5.5 trillion. But the problem is that the laws of large numbers eventually apply. You cannot have exponential growth in a business that is $4.5+ trillion go on forever. We have a $30-ish trillion economy. Right. If it grew like that, sooner or later, it would be bigger than the whole economy, which is mathematically an impossibility, right? It's a part of the economy. It can't be bigger than the whole thing. So I'm just saying that at some point, the largest companies' growth rates mathematically must converge to GDP growth. And therefore, I'm not interested in having a position where 30% of my entire investment portfolio is tied to one investment theme. It's just too much.
Sounds like they need to spin off so they're not so big so they can grow.
Well, I mean, the other part of it is that, if the trade continues to work, and I believe it will, I mean, AI is a big thing.
Sure.
It's not like this is just going to go away and
No.
it's not going to matter. I'm not saying that. I'm just saying that if you own the S&P, so much of your investments are tied to this one thing,
Sure.
and you don't need to have that much concentration. So I just sort of said, well, I'll peel off the poster child for this.
Okay.
And the other thinking, by the way, Meta, Alphabet, those are companies that they have exposure to the trade. Alphabet's interesting because they design, right? So the Gemini side, some of their collaborations right now are based on chips of their own design. I have long felt that they were underappreciated on the AI side because I've been fascinated by them ever since they beat Go, right? So their DeepMind thing from years ago, I was impressed as hell with what they were doing. And they work more on the logic, inference, and search side of AI, which I think doesn't get as much interest right now as large language models do, because large language models we interact with them the way people think AI was going to be. HAL from Space Odyssey and all that kind of stuff. A machine that you talk to and it talks back.
Mm-hmm.
That's like most people's view of what general artificial intelligence should look like. But artificial intelligence overall is a broader field. It has multiple branches. Logic, inference, and search optimization. Some of these are really big, hard, NP hard problems that I think I have a feeling Alphabet's probably in a very good spot in that area. And so I think, you get plenty of AI play with the rest of those stocks. So I say that and just watch NVIDIA go to the moon. It'll be a $10 trillion. Having said that, it'll be a $10 trillion company this time next year, and people are going to think I'm a complete buffoon.
Yeah.
Say, if only you'd used AI to figure this out, Mike, instead of just your heuristics.
If I was good at editing, I don't edit my videos. If I would, I was definitely ready to throw the not financial advice as you were talking about the numbers of it should be trillions.
Well, yeah. I mean, this is just, again, this is not about financial advice. It's about a way that we think about investing, the markets, securities, and the world around us. And also just math, right? So why did things like indices work? It's because there's a power law in there. The success of an index is carried disproportionately by its most successful constituents. So it's one of these things where people, I'd say, most people are of below average intelligence, and people say, well, that can't be. Well, actually, it has to be. The median and the mean are not the same thing. And so it is also true when you're looking at the constituents of a stock market. It's, most stocks are below average.
Sure.
Unlike Lake Wobegon, that NPR show that they used to have, where he would talk about Lake Wobegon, where most of the people were above average.
I'm not familiar with that one, but no, I definitely.
Prairie Home Companion. It was a show on National Public Radio for a while.
Gotcha.
Yeah.
So, not sure how we we went pretty far on the original question. I don't mean that insulting it anyway. I was asking about the puts on ULTY. Do you guys ever consider taking assignment? That's what, because we talked about selling. I was saying, sometimes we also sell puts, and then we talked about with NVIDIA and then why. But do you ever think about taking assignment in like an ULTY where you actually do have the shares anyway, as opposed to like buying to close those out at a cost? Has that come up? Okay.
I mean, here's a way to think about it also. So there is a certain portfolio concentration that's kind of like a full allocation of the portfolio, if you think about it like this, and some that are slightly smaller. So people who will go back a couple weeks will remember that we bought 200,000 shares of Alphabet. And that was actually a very fortuitous time that trade went in, because It wasn't until the end of the day. I was just looking at the P&L, and all of a sudden, Alphabet just popped. I was like, what just happened? Because it was after the close on Friday. That was when Berkshire Hathaway announced that they'd acquired 17.9 million shares. And then we've gotten news since then. But the interesting thing about that position is that you'll notice it was about a $55 million allocation out of the $2 billion, whereas NVIDIA was 77 million around the time. So, 50% larger. In a fund, you could sell 1x2 put spread. So you've got the tail risk hedge on in Alphabet, long 200,000 shares, could have done a 2,000, 4,000 1x2 and take an assignment on another 2,000 or at least another one. So another 100,000 shares. Because if you did that, first of all, you're collecting the extra extrinsic premium. You legged into the stock now at a lower effective cost basis. Clearly we liked it and we weren't fully allocated. So the short version is, can we do that? Would we do that? Should we? Well, I mean, the should depends on the circumstances. Could we or will we? Well, yeah, I think the answer to that is yes, depending. And I think that often is the case when you're adding new positions that you like. Every trader experiences the exact same thing. You've made a determination. I want to buy the stock. Do you buy all of what you would buy at that moment? Or if you just say, wow, I like what I just heard out of earnings, but the stock's up 6%.
I can tell you, I'll make the wrong decision every time.
Well, but see, the thing is, the right decision is you will never have more information about the underlying stock than you do at that moment. It's why I hate it when people ask me, what do you think about a stock going into earnings? Because I will never have less information about the company than I do at that moment. Because there's all of this information that's about to come out. Sure. We're 24 hours away from having the answer, and you're asking me to guess what it is before it happens. Unless I have inside information, which I don't, and if I did, I can't trade on it. Right. The short version is I'm never going to know less. So when it comes out and the stock's up 6%, and if I do what I just talked about, which is I'm that ratio put spread plus the covered calls, I'm kind of covered now, right? Because I can buy like a 2/3 allocation. And if it does come in, if it gives back some of the pop that came out right after the event and the new news is being digested, then I'm going to benefit. And otherwise, I'm just going to collect a little bit of premium on both sides, and I'm already long the stock, so we can work our way in over time. I think sometimes just from a trading psychology point of view, this is an appealing way to get into positions. I mean, whether you guys are doing this just in single stocks you're interested yourself, or if you're wondering why the traders are doing the things they're doing, it's about maximizing yield and also trying to enter stocks at the most attractive prices. And sometimes, by the way, if I do that trade, it doesn't matter in Alphabet because there's so much liquidity. Like you can enter a $50 million position in Alphabet like that, but you can't do that in every stock. So in some cases, if I put the options trade against a long, a partial long in the underlying shares, there might be more liquidity because I'm not just taking on a huge amount of deltas. That's more than that name can absorb. Okay. So there's a liquidity consideration that can also work in your favor when you do these kinds of options trades around them as well. And this is a very common thing. It's not Omega, which was founded by Leon Cooperman, former head of Goldman Sachs Asset Management. He does a lot of strangle sales around core positions, both long and short. Glenview, another big hedge fund. This was a common practice for them to do, because they could add more stock at levels that they think are favorable that they already like. So it makes intuitive sense and can facilitate bigger positions, and if the name isn't quite as liquid.
Sure. Okay. Well, thank you. No, I've never once seen an assignment, so I didn't know if it was just it's a principle. We're not taking assignment. We're not exercising, but we have the ability. If
we have the ability, okay. Yeah. I mean, it's not going to happen that often, and in a fully allocated position, you're probably not going to see it. Did I just see some? Oh, that's interesting. Why did my ULTY position suddenly change? This is only supposed to be updated overnight, but I just saw it tile as if something happened. That shouldn't happen right now. The market's closed.
So
I don't know. Maybe the people who update the website tried to drop something early. I have no idea.
Yeah, so your holdings
So
actually on a normal close night, your holdings download that is for the following day actually comes out by about 8:30 at night because I'm usually updating my spreadsheets that night for the next day. So,
oh, really? It's 8:30. I don't
well,
keep
my
really
time,
close
yeah,
track, but yeah.
yeah, but with the market closing earlier, maybe it pulled forward, but that'd be a large pull forward because generally your intraday trades don't come out until about an hour and a half after the market closes. I usually can download them at about 5:30, and I can download the following day's holdings by about 8:30.
5:30 Eastern
My
time.
time, yes.
So 5:30 Eastern time
So,
normally.
yes.
3 hours earlier is 2:30. It's after that now.
Well, that'd be the trades.
Because the market closed at 1. So the trades.
That'd be the trades.
Yeah.
And I didn't check because I didn't know if everybody was pulling time forward. That would be helpful for me, but I figured I'd just check once the interview was over. But then the
Yeah.
but then the
I don't know.
holdings.
I mean, it could be a quirk in Bloomberg too. I don't know.
Sure. But so we've gone a little over the hour. Do you have time for 2 more questions, or
Sure.
you okay? Okay. So I'm switching the order because I basically this next one could be seen as like a negative. Not that it is, but I'd rather end on a more positive note. So I'll go to the fees question here, and then I'll just end with a general question. So I've had a question trying to understand on how we can look on the website and we see 0.99% or 1.3% as the expense ratio on the different funds. Obviously, the more like an ULTY has a whole lot more active management than say an individual because they don't have to select different funds and do all the different. They're just trading one fund. But how does that expense or fee, call it, get taken? How do I, the investor, end up paying that fee? And then follow up to that, if I buy like a YieldMax, am I paying the fee to YieldMax? But then since YieldMax purchased the more YieldMax funds, is it paying twice?
No. So the YMAX does not pay twice. So the way that is structured, essentially, is that it's not going to charge you, right?
Okay.
That's not the way that works. So there basically is a benefit that's remitted back in that. So you're not going to end up paying those fees twice. In general, when you're thinking about fund accounting, so I'm speaking at a high level because I'm actually not a fund accountant, but the way it was always accounted, the way I saw it as a fund manager, was that the fund is assessed fees which accrue on a daily basis on the fund's total assets. So there's no like concept of the number of shares necessarily. There's just a pool of money. Whatever that pool is, you basically have an expense ratio rate that's getting charged to it, plus whatever other things that are naturally going to come as a byproduct of trading related expenses, things like that, just get charged to the fund overall. And then individual shareholders, but it doesn't really have that much of an impact from a shareholder's point of view. You just think of it as, okay, if there's a 1.3% expense ratio, that's basically accruing daily. And, over the course of time, that's how it's going to hit. I will say this, that for a fund that's as actively managed as ULTY is, having worked at a hedge fund as well and having worked at a prop trading firm as well, when I think about what the fees are, this is more like a hedge fund product at a mutual fund fee, right? Because hedge funds, typically charge a performance fee as well. And in many cases, the base level fees are much higher.
Okay.
So I find it kind of fascinating when people start talking about fees, because if you look at how much trading activity and involvement goes into this on a daily basis, it's a lot,
Sure.
right?
Absolutely.
And these are also, the other interesting thing is that relative to a hedge fund, these are in a more complex regulatory wrapper as well. Hedge funds don't disclose their trades and transactions each day. They're not a 40 Act fund. I mean, so you're living in, and they don't trade like a stock, and they have lockups and gates. So when I think about it on a relative basis, that somebody says, oh, I could do this strategy in a hedge fund, or I could do it in an ETF, like how much better the ETF is for investors is it's just orders of magnitude.
Sure.
Right. Now, the next thing that has to happen is the fund managers have to perform, and this is an actively managed fund. And what does active management mean? What's the benefit of that? In theory, that is that you can change with changing market regimes,
right?
Adapt. If something that worked once is no longer working, you change it and you find what does. And so this is something that also was not common in the ETF wrapper up until relatively recently. Now there's a lot of actively managed ETFs, but this was not a common thing. They were thought of as like a passive investment product. And that's the other part that we're working on. So it's one thing to charge fees. The important thing is to earn those fees. Sure. And earning those fees means doing the job, and we're trying to make some changes there. We think they're positive change. We think it's the right kind of an evolution, and we hope that that's going to yield the kind of results that investors are looking for.
So I want to clarify something you said so we don't send people running for the hills. That let's call it 1% just to make it even, because we've got ranges based on the different funds. But that 1%, when you say it's a daily, we're not talking about 1% daily. The fee isn't 1%. Right? I don't want to scare people.
No.
That's an annual.
That's an annual fee that is it's the same way. If you're earning 4% in your money market account, you're not getting 4% a day.
So a person who
it'd be a lot easier to put money in the bank if you did.
Okay, so a person
that's the
people
rate.
You hear people, my fees or these fees are too high. I mean, if you were in for a month, you basically paid 1/12 of 1%, right?
Yeah, that.
rough math.
Yeah, it's a small amount. That's right. You put $100,000 into one of these things. That means that in round numbers, the fees over an entire year to manage these assets actively, trading that money every single day, would be 1% of the assets.
Right.
That's when you consider how much activity is going on here. I mean, the whole idea with these ETF wrappers is to democratize access to the strategy, but part of it is the reason to do that is because doing this yourself is tough. I mean, if you're trying to sell weekly covered calls, but you also wanted to make sure that you adjusted them when the stock moved up or moved down, you would not have time for a day job.
Right.
This is a full-time thing.
Right.
I mean, so that's why you see 8-9 million contracts traded across the YieldMax funds in a week. That's a lot of options trading.
I understand it. Sometimes I feel like not everybody understands, especially complaining about 1.3 when this other fund over here is only 1.1, and you just made 30% this year, and you're upset about
SPY is 3
1%.
basis points or something like that. I don't know what SPY is. I'll actually look it up. It's something very, very low. But SPY doesn't do anything.
Sure.
I said 3 basis points. I was exaggerating. It's 10 basically. Their expense ratio is 10 basis points. Okay. But how often do they transact? I mean, there have been, 6 ins and outs in the S&P 500 portfolio all year? We added Hood. We added Interactive Brokers. There's like 6 ads. I mean, in a year, and it's just stock. It's not like stock plus calls plus puts and all this other kind of stuff. It's just like, set and forget. I mean, it's a brilliant business, It's not a bad thing to be BlackRock either, let's be honest.
Yeah. All right. So my last question before we wrap it up, I like when you give us back of the napkin math. So is there a good, so let's say I've got a small portfolio, but I mean in my videos I've explained it to my viewers. So I cashed out, and this is definitely not financial advice. I cashed out a pension from my former job. I did not stay for obviously an entire career. It was about 14 years. So it's a chunk. It's not enough to retire off of. And what I've decided is I took the fees, took the taxes, and I'm investing it into a portfolio that I'm making of my own of income ETFs.
Did you roll that into was it like a 401k that you put into a self-directed IRA?
No, so I still have my 401k. I want to be able to use this money as income. So I took it out of a cash balance.
Oh, in real time.
Yep.
Oh, okay, gotcha.
So it was a cash balance pension fund. So traditional pensions are pretty much gone unless you're, in those lucky areas that still have them. So it was a lump sum of cash. Kind of follows similar to the 401k type rules. Since I'm too young, I paid fees to take it out. I had to pay taxes and penalties, whatever. I don't even care. But I'm employing this or putting it into income ETFs. And I'm trying to figure out percentage-wise, because I want to use some of the income to help pay bills, pay living expenses. But I also understand that reinvestment is a part of it. We even went into the fact that, sometimes you're going to pay out based on selling protective puts that made us money. Well, in order for me to protect that NAV, I need to reinvest that money, not take it out. So is there a good way? And it's not on all the time. It's probably going to depend on how the funds are doing as well to determine what's a smart percentage to use versus a smart percentage to reinvest.
So my thinking on this is based on what I want the core assets to be, the sort of the effective balance, if you will, of income producing assets. Now, this is going to be a function of two things. If there is not an immediate need to use it, and if the amount of time over which you intend to use it is undetermined. So let's say that you could live forever. Right? Nice, you could live forever. But in other words, the idea is that this would be an ever rising pool of assets from which one could draw, or beneficiaries could draw. So if you treated it like a trust, then the objective would be that the net asset value in the aggregate, this is not a function of how many shares you have. So I know a lot of people like to think about it like, I have 1,000 shares of XYZ. Right. How much does each share pay? Think about how much you have in total net assets, and then what you think a realistic distribution rate from those assets is. And I think that's the way you're trying to think about it. To me, if I had an undetermined or indefinite future from which beneficiaries would be drawing from, call it a trust, my objective would be for the net asset value to grow at approximately the true rate of inflation. And the true rate of inflation is probably closer to 5% than it is to the posted CPI numbers, right? So you mentioned, I think you said Chippy, right? You had Chippy?
Yep. Yes.
So let's think about this in practical terms on Chippy. So Chippy has only been around since April 3rd. Of 2025. It's had total returns of 58% since then, and the price change itself is 23%. You could realistically have taken all the money that you got. You could take all of it. You could have even taken some gains if you wanted to do this, and then taken some of that and reallocated if there were other things in your portfolio that similarly have high distributions but whose performance is lagged. You could rebalance to try to get back, taking a little from the winners and putting it towards the losers. Now, the caution I would offer about that is that as a trading philosophy, that's not that great, because you should let your winners run, frankly.
Right.
But in this case, in Chippy's case, if I needed income, I might not have dripped any of that. I might have literally taken every nickel and said, okay, that's what I'm going to do. In Strategy's case, which has been, Strategy's been annihilated. I've already articulated that, again, not investment advice, folks, but I just think Strategy's cheap relative to Bitcoin, and I'm a long-term Bitcoin bull. So from my perspective, if I was going to allocate, I'd say, well, if I like Strategy 30, 40, 50% higher than it is right now, and my underlying thesis remains intact, then I probably would be taking some of the excess distributions that my winners were giving me and reinvested in there. Then the whole portfolio's net asset value is just going to stay, growing at about that 5%.
Okay.
Then there are other stocks like Moderna, which, for what it's worth, I was not a fan of Moderna. I was not a fan of Pfizer. I've never been a fan of either one. I was not a fan of them when they were going up. I was not a fan of them coming down. Those are the kinds of things that if you happen to be in Murney and you're kind of thinking, well, the bloom is off this, always have to every 6 months go get another shot thesis that was the reason to go buy Moderna in the first place, maybe you take the distributions and you just say, maybe that thing bounces back. I don't know. It's the stock's down 95% from its highs. It's a cheap call option at this point. Do I just keep the thing sitting around? I mean, it's down at such a point that if I had it in my own portfolio, I don't. But I would probably feel like, I'll leave it in there. Maybe they come up with something.
Sure.
It's a big nothing burger otherwise.
Okay. Yeah, I feel the same way. Yeah, so I'm gonna basically take each ETF on it as its own individual. Right, I can't apply like an easy. I can use 30%. I need to reinvest 70%. There's not real simple.
I would just look at the whole portfolio. Make sure, first of all, there is the issue of investor preference in the individual securities because you believe in the underpinning thesis. So Chippy is pretty easy one to figure out because you can see what's in it. If you like those stocks and they're performing well and you want to stay in it, so you don't sell any shares. But if there are some other things that are coming off, let's say you had $100,000 to start the beginning of the year. What do I want in my account in a base case if I'm living off of the assets? $105,000 at the end of the year. So that's the total net asset value. I'm taking distributions all along the way. How am I reallocating those? Well, every single time I get a distribution, I'm looking at each one of these securities and saying, yes, no, yes. So yes, personally, yes, Misty, I would reinvest some into that. I told you what I thought about NVIDIA just because of the laws of large numbers. So in Chippy's case, I'm taking distributions. Am I putting more back into Chippy? Yeah, probably not. I mean, I'm not selling Chippy because you let your winners run.
Sure. Yeah,
but
and I'm not looking to sell.
I'm not looking to add to a bet that has had such a great tear. I'm going to look for some opportunity to deploy a little bit more capital to the things I think are now underpriced.
Okay.
The Mernies of the world, again, not a fan, so I wouldn't put any money into Moderna because I just don't like Moderna. That's me, and I'm sure there are people who know more about it than I do and are going to say, no, Moderna's a winner for a host of reasons. And then, you can live off the rest. That's the way I would look at it.
Okay.
That's the way I do look at it. Right?
Sounds good. Well, we're coming up on like an hour and a half now, so I think I'm ready to let you start your weekend, especially since the rest of the guys got to have the day off that weren't traders. So. Well,
it's interesting. My wife is flying back. She went to see her mother with our younger son for Thanksgiving, and she literally pinged me, I think, from the Denver airport because she had a connecting flight. I'm probably going to go with my other son. We're going to go meet up with some friends and enjoy the afternoon and the upcoming weekend. And so I hope you and your viewers do the same.
Very good. Sounds good. So last time you made us laugh with a joke, so this time I'm going to tell you my favorite one. I've told it on my channel before, but I haven't told you. So it's better if you're outside with somebody to do it. But in any case, I'm sure you guys, I guess I assume I've never been to California. You guys get the Canadian geese flying.
We get a lot of geese over here. Yeah, okay. There's a lot of geese. Yeah.
So you know how when they're flying, they're always in that V-shaped formation. You ever notice? Sure. You ever notice how one leg of it, one side is longer than the other?
I suppose I have seen that. Yeah.
You know why that is?
I have no idea.
More geese on that side. All right. That's my go-to. That's my best one. You got to be completely serious, especially if you're outside and you're pointing it to somebody and you get them.
I am going to use that for sure. That's good.
All right, Mike. I appreciate your time and all your knowledge that you're passing on to us, and thank you for coming on to the channel.
I appreciate you having me. I look forward to talking to you soon.
Same here. Thanks, Mike. Have a good one. Bye.